And of course, tensions between Iran and the US are heating up. US President Donald Trump is sending troops to Saudi Arabia to bolster its air and missile defences. Well, both Saudi and the US say that Iran was responsible for last week's drone attack on the Saudi Aramco oil facility.
For more, Credit Suisse analyst Sol Kavanagh joins us live at the desk. Sol, great to have you here. How significant was this drone strike? Because we saw the reaction in the oil price, but is this a really big deal?
Indeed, it is a big deal. It's actually unprecedented. So the level of supply disruption we saw in the wake of these attacks is the largest on record in the oil market. So that surpasses the Iran-Iraq war, Saddam Hussein's Iraq invasion of Kuwait in 1990, even the disruption from the Islamic Revolution in Iraq.
And this is just a couple of drones.
Well, it's a very targeted attack on what is probably the single most critical piece of oil infrastructure in the world. So in and of itself, it accounts for over 5% of global oil supply. And so you can understand why the market has reacted in the way it has.
But just in terms of the market reaction, though, as far as I understand it, the oil price briefly bounced above $70. It's back around 66, 67 or something like that, which certainly wouldn't suggest a crisis. So how do you explain that disconnect between the oil price and your analysis?
So in the initial jump we saw was actually another record-breaking, was the highest opening jump in oil prices we've ever seen in the oil markets since they've been basically recording them. And that was because at the time there was still a huge level of uncertainty regarding the extent of the damage and how long it was going to take to see that disruption repaired and resolved. Now, subsequent to that, the Saudis have announced that they're expecting full levels of prevailing production to resume by the end of this month and full capacity to be up and running by the end of November. So that's seen oil prices come down a little bit, but you're still seeing this premium compared to what we saw last week, and that's because there's still seen as lingering risks here hanging over the oil price.
You think that surely this time the Australian government will finally decide to lift its minimum reserves up to the 90 days?
Well, there's going to be more pressure on that, but of course there's still the fundamental structural drivers behind that haven't been resolved yet, because even if we do meet that 90-day target, that doesn't mean we're going to actually have the fuels we need. So it's actually a broader value chain discussion that still needs to be had in that regard.
To that point, interesting, our reporter Matt Cunningham was talking to Matt Canavan, the Minister for the North and Resources, in the last 24 hours. Now, here's the Resource Minister talking about that security and what the Beetaloo Basin could do for it.
Now, the Beetaloo Basin in the Northern Territory is the first shale opportunity in Australia, first major one. And it's great that it's here in the Territory for you guys, but it's also of a national interest, in my view. Given what's happened in the US, we should also be seeking to apply similar technologies here as well.
Now, Solly is the Minister for the North, of course, but do you think this is a viable proposition to actually help with security?
Well, indeed, I was up in Darwin a couple of weeks ago with the Minister at the conference there, the Oil and Gas Conference. A lot of hype around the Beetaloo, but we need to also have a bit of sober reality around what the prospects are here. Yes, it is a huge, unparalleled size resource, but that only means so much. It all comes down to what is actually the sustainable cost to get this out of the ground. And the truth is, we're likely going to have to see hundreds of millions of dollars spent before you see any kind of commercial payback, which to be probably at least 10 years. And is there that level of appetite to actually invest, to prove up the sweet spots, to see if there is commercial scale there? To date, the answer seems to be no. So that's still a prospect, if it's successful, is more than 10 years off large-scale commercial volumes. Again, that's only in the success case.
So what about the other big deal that's going down, which could be what really impact the East Coast gas? This is the ExxonMobil sale, potentially, in the Bass Strait, is that right?
So we saw a very unusual announcement from Exxon this week, where they announced that they're at the early stages of looking to exit Bass Strait. So to be clear, Bass Strait is the single largest producer of gas for the East Coast gas market in Australia. It's roughly a third of domestic gas supply. And Exxon, which has operated this going back almost 50 years, is now finally looking to sell. For Exxon, corporately, it's now in decline. It's non-core. There's large abandonment liabilities. You can understand why Exxon's looking to get out. What's less clear is who's going to look to buy this off them, because the normal players, the ticket price here is probably going to be around $3 billion or more. That's going to rule out smaller players. The majors aren't interested for the same reason Exxon's no longer interested.
But it's quite a messy asset, isn't it, in terms of clean-up and all sorts of stuff?
And the biggest uncertainty around the valuation here is the abandonment liabilities. There is billions in abandonment liabilities, and the reason I can't narrow that down anymore is it could be anywhere from $2 billion to $12 billion. And that is a huge problem for the regulator as well as for a new potential buyer.
Just finally, Saul, just on the question of Australia's oil reserves, I've often wondered why it is that we only have 56 days. Are there particular vested interests in Australia that would prefer the stocks to be lower than higher?
Well, it's a mix of factors. I mean, one comes down to, in the past, Australia was a very large oil producer, and now that has declined, and we've obviously become a leader in gas. But on the other hand is also what's happening in the refining space, where we've seen, obviously, the closure of refineries. So there's a limit to how much we can have a lot more crude, but if we can't refine that into end products, we're still going to be left with the same level of shortages as we do otherwise. And that's, therefore, why it's a much more complicated issue for the regulator and for the fuel companies in Australia compared to, say, in the US, where they've got a much greater depth across the entire value chain.
Indeed, fascinating. Well, we do have to leave it there, but thank you very much, Saul Kavanagh from Credit Suisse.